is cash is prominent in all of the business cycles. We're going to focus, as I said, on cash receipts and cash disbursements particularly. So when we talk about cash, what we're thinking about is cash in the bank, right? So a company collects cash, they deposit the money, so we want to see that there are controls over cash. It's very important to have controls over cash because it's a highly liquid asset. So some of the misstatements that you usually see with respect to cash, because one of the things we'll talk about when we talk about the audit procedures for cash is that what we expect to see that companies are performing a bank reconciliation. So basically they are reconciling the difference between what's recorded in the general ledger in the cash account and what's on the bank statement. So auditors are going, that's a control that auditors are going to look for when they assess the controls over cash. And some of these things that you're unable to find by just merely performing a bank rec, right? Because a bank rec just says, okay, here's what I have on the books, here's what the bank says I have, what are the differences? The types of differences that are going to come up are going to be things related to timing differences. So timing differences for when checks are clearing the bank and when the company actually issued the checks, or timing differences for when receipts are recorded in the bank statement versus when the company actually deposited the receipts. The types of things that are not going to be there is a failure to bill a customer. Right? If you fail to bill a customer, you're not going to identify that by looking at the difference between your bank account and your books. Why? Why do you think that is? Why is that not evident by looking at the bank rec? What does failing to bill a customer even mean from a transaction or an accounting perspective? What happens? What does it cause? You fail to bill a customer, what does that mean? Yes, Vivian. There you go. Simple. It's not on the books. If you fail to bill a customer, you didn't put it on the books. So if it's not on the books, it couldn't possibly be in the bank because you didn't bill them. You didn't bill them, so it's not on your books. You didn't bill them, so you didn't send them an invoice. They're not likely to pay you. You don't send them an invoice, well, I guess I got it for free, right? So you'll never find that in a bank reconciliation. The other thing is if someone is embezzling cash receipts from customers, you're not going to find that in a bank rec either. Why? What control is lacking? Where's the control breakdown there? If someone's embezzling, everyone understands what embezzlement means, right? Just had this on a test. Might be why people got it wrong. What happens? If you're embezzling, what control is broken down if someone's able to embezzle money, cash receipts? Well, that's right, you have a lack of internal control, so it creates the opportunity to embezzle. But what's happening? When someone embezzles money, what control is not in place? Jimmy. Right, so those are all factors, but what's the control? So there's probably a segregation of duties.
What if happened to the functional capabilities, like the authorization?
Right, so it's probably that there's not a proper segregation of duties, that if someone has the opportunity to steal cash, that means that person has custody of assets, right? Cash comes in, or checks come in, and there's no oversight. There's no one checking to see, that the cash that comes in the door is immediately deposited, that someone's reviewing cash receipts. So there's a breakdown in internal controls. If they're embezzling the cash receipts from customers, there's a breakdown in internal controls. That cash never hits the bank. So you're not going to see that in a bank reconciliation, right? Because it never got deposited into your cash account. Right? So, and if it never got deposited into your cash account, you've never recorded it. Because if it's stolen, right, no, it's not as though someone's going to say, okay, let me record this cash receipts and then I'm going to steal the money. If they're stealing the money, they're never recording the cash receipts in any way. So you're never going to see that through your bank reconciliation. Where might you see that? When might it come out that there's an embezzlement problem. What might raise a red flag? Accounting. Think about the accounting transactions. Yes. Right, you're going to see your accounts receivable, right? Because that receivable is going to be there. You're going to see that come out in your aging. Something's going to be wrong with the aging, right? There's going to be a red flag because you're going to notice that that customer has not paid you, right? The company's going to notice they haven't received payment for that accounts receivable. It's going to, and what happens when you don't pay? The company's going to send the customer another notice and another notice and another notice. The customer might ignore it, but more than likely a customer is going to respond that, look, I already paid you for that, and here is a copy of my check, and here is the clearance, you know, the fact that the check cleared. So then that might point to a red flag, but that's not necessarily timely, right? Because there's a breakdown in internal controls. So all of that to say, basically, there are errors in cash or misstatements that could occur in the cash that you will never find as a result of doing a bank reconciliation. And that's to say that just merely